Good afternoon, everybody. Scott Riley with the Market Update Desk, NMLS 157524. It's June 2nd. Believe it or not, we're in June. We're moving very quickly towards actually the summer equinox, June 21st. Hard to believe. We're only a couple weeks away um, to halfway through the year. Kind of wild. A lot going on. Touch base on the wonderful Detroit Tigers. They actually pulled off a win last night, which was surprising. Although the bullpen did try to give it away, they jumped out to a big lead. They held on by the skin of their teeth and held on to a 10-9 win yesterday. So at least a small positive for the Tigers here. In the news today, we start with jobs data flowing in today. It's jobs week. Let's go right into it. So the BLS reported in April on their JOLTS report, the Job Opening Labor Turnover Survey, showed that there were 7.6 million job openings. Now that's up from 6.88 million the previous month and much higher than what the market had planned on at 6.9 million. Now, within the report, we saw the hiring rate fall from 3.5% to 3.2%. This is just off its lowest level since 2011, when we exclude the COVID years. Now, this is the quits report. Also within this report was very interesting. Fell from 2% to 1.9%. It's the lowest level since 14, excluding COVID. Now, this is showing that employees are not voluntarily quitting as much as previously because there is concern on obtaining another job. So there's not as much poaching going on from company to company. Now, we have started on a new month with a new Fed chair, Kevin Warsh. So he's going to lead the Fed and could potentially place a greater emphasis on a very specific metric, and that's from the Dallas Fed. That's called the trimmed mean inflation measure. Now, when assessing interest rate, they're going to look at this when assessing interest rate policy. While core PCE inflation currently stands at 3.3%, the Dallas Fed's trimmed mean measure is running closer to 2.3%, so obviously much lower and closer to what the quote Fed target rate of 2% is. Now, this trim mean attempts to get a better read on underlying inflation trends by excluding the most extreme monthly price movements by removing the highest 31% of price increase items and the lowest 24 price decline items. Now, Warsh argues that this approach filters out temporary distortions in the market caused by factors such as tariffs, geopolitical events, energy price shocks, and surge in investment spending. The goal is to provide the Fed with a clear view of persistent inflation pressures. If the Fed were to place greater weight on the trim mean measure, it could strengthen the cause and intention of what a Warsh Fed would potentially look for, which is interest rate cuts. The measure, though, is not without its flaws. There's a couple of interesting things. The methodology was developed during a period when price declines trended to be larger than price increases. So that helped correct for historical bias in inflation dates between 1977 and 2009. However, though, some economists argue that the metric can lag during periods of accelerated inflation, such as what we had during COVID. And so we're just not sure what that's going to mean. Now, as an example, the Dallas Fed's trim mean remained below 3% until November 2021, when we were going through COVID. Even as broader inflation pressures were building, critics contend that was because price increases have become more common in recent years. The measure may understate inflation when inflation is rising rapidly, even if it does a better job of identifying underlying trends during disinflationary periods. This is part of what the new Fed Chair Warsh wants to do, is change some of the metrics that they focus on. They're still looking at all of them, but trying to get a real measure of trends, lag, and get better metrics to make decisions, because during COVID and just out of COVID, the Fed was way behind the curve in assessing inflation. Their classic line was the inflation that we were seeing was transitory. Maybe adding these other metrics into discussions for Fed policy will help create a better understanding of where truly we are at the moment. Now, after managing, so for mortgage-backed securities, after managing to close above the 50-day moving average yesterday, we are being challenged with a new level of support. If the level fails, there is another floor to the downside um, for the 25-day moving average. So we're watching this very closely. 10-year Treasury has been moving slightly back and forth. We're seeing a lot going on still geopolitically with the Middle East. Are we going to have a ceasefire? Are we not? Iran appears, at least now, uh, appears to be backing away from a temporary ceasefire. So there are skirmishes happening between the two countries. Currently, the 10 years at 4.453. We're down about 2 basis points today. The Dow up again 150 points, continuing to surge. In fact, one of the stocks I was following, which is Marvell, has had a massive run over the last 4 months. So we're seeing a lot of the growth within the Dow, S&P, and Nas centered around the tech side. So it's not necessarily a broad-based increase. We're seeing it in a smaller segment. In fact, when we're talking about tech, Anthropic uh, is expecting their project Glasswing, I'm sorry, to expand to an additional 150 partners in more than 15 countries. That's their Mythos increase or program within their AI program. So they're slowly rolling that out to more people. There is still concern hackers are going to get access, leverage it to be more adept to hacking, and exploit existing software vulnerabilities, which are in major companies right now. Today, we also have a lot of multiple state primaries going on within for House seats, Senate seats, and governorships. So lots going on today. We're going to get more employment data later in the week, but we'll keep you up to date. Scott Riley, the Market Update Desk, 616-293-2189, your original singular market news source for West Michigan. Still seeing a lot of activity in the market. It's a great time to buy right now. Talk to you soon. Bye bye.